So you're living here in Canada, thinking about making your next move, whether it's buying a house, investing, or planning for your future, and there are two huge economies really manipulating all the variables that impact your decision. And that is Canada and the US economy. We're neighbors. The economies are connected, but they are not the same. In this video, we're gonna look at how Canada's economy is doing right now, how the US economy is doing right now, how the two are deeply connected, and what that means if you're living here in Canada, thinking about your mortgage, your future, financial planning, and overall how this impacts you. You might be asking yourself, why does this even matter? Why compare the US and the Canadian economy? Well, that's because our economy doesn't exist in isolation. The Canadian economy affects a ton of different variables that impact our day-to-day life, like interest rates, housing, and jobs. And then the US economy influences our economic performance based on things like what we sell, what we import, and how trade flows across the border. As a mortgage broker, I see clients hyper-focusing on interest rate and home prices, but very few look at the big economic picture. If the economy shifts, it can change everything. Your job security, your monthly budget based on day-to-day expenses, and your overall ability to buy or even sell a home. And like I said, both economies are intertwined, the US and the Canadian economy. So understanding both gives you a ton of clarity. Here's the big picture. Canada's economy right now. We're gonna start with growth and overall living standards. According to a recent study done by the Fraser Institute, over the 2020 to 2024 period, the GDP per capita here in Canada actually dropped by about 2%, which is the worst 5-year drop since the Great Depression. That means that although we had aggregate growth, the average Canadian standard of living actually decreased. So growth isn't actually just about big numbers. What matters is what's happening to each and every single Canadian independently. And just for your reference, aggregate growth refers to the overall increase in production of goods and services across the country. With all that being said, we had a really good start to the year. In January, industry-level GDP rose 0.4%, which was much more than they expected. But the growth is facing headwinds. According to the TD Economists forecasts, Canada's only expected to grow this year about 1.2% for the entire year here in 2025, with further softness ahead. And when I say the word softness, we're not talking like, but you know, now we're at one of the most important parts, trade, exports, and the US connection. Canada sends about 3/4, 75% of all the goods produced to the US each year. For example, in 2024, trade in goods and services between Canada and the US reached a whopping $909 billion. What this means is that when the US economy takes a breath, policy changes, Canada feels it too. That's because our factories, our energy, and our auto parts are very linked to American demand. Just look at what the tariffs did to Canada in Q2 of 2025. Canada's exports dropped by almost 8% in things like aluminum, steel, and auto parts. Another key piece is real estate and overall debt exposure here in Canada. Canada's housing and mortgage sector is a big part of our economic story. People say between 1/3 and 1/2 of the Canadian economy is tied to housing activity. And that's because many Canadian households took on big debt and are really sensitive to interest rate changes. Affordability is pretty challenging here. Qualifying for a home takes up a larger share of income than it does in many other places. And because of this, economic softness or rising unemployment can ripple quickly into the housing market. So for our purposes, mortgage brokers, prospective home buyers, we're watching the economy and the housing market as two connected systems. Let's jump the border and take a snapshot of the US economy because it's much larger and much more diversified. Its sheer size and diversification gives it some massive structural advantages. For example, Canada's nominal GDP is between 2 and 3 trillion, ranking us at about 10th globally. While the US, it's at about 20 trillion. For Canada, this means we're more vulnerable to external shocks. That's because our economy is smaller and more trade dependent. In the US, housing still matters, but the economy has broader foundations. Things like technology, services, global firms, etc. This gives more of a buffer during downturns. However, the US is not immune. Things like inflation, high debt, policy uncertainty, global supply chain risks, these things all affect the US economy. And because Canada connects into that via trade, we're tied right into those risks. How tied, you might ask? Well, let's look at interconnectedness, how Canada and the US are actually linked. Here's the critical piece. The story isn't Canada versus the US in isolation. It's how they move together and how Canada is affected by US policy, demand, and world economic shift. For example, Canada is the #1 export destination for 34 US states. Another point is that Canada's reliance on the US means that when tariffs are raised or demand in the US drops, Canada does take a hit. The Q2 export plunge that we discussed a little bit earlier just proves that point. But with that being said, a lot of stuff from Canada also flows across to the US border. An auto part made in Ontario may end up in a car that's being built down in Michigan. Energy from Alberta may end up supplying industrial plants down in the US. These chains mean that whatever might slow down the US manufacturing engine can ripple over and end up slowing down Canada's manufacturing sector. On the flip side, Canada's really stable and we are a resource-rich partner. So whatever happens here ends up rippling over into the US too. Think energy. Canada is a major supplier of energy to the US, be it oil, gas, and raw materials. So the relationship between us goes both ways. Trade experts describe it as a deeply integrated relationship, not just as import-export, but investment, value, and employment driven as well. So when you're thinking about things like home prices or interest rates here in Canada, you can't just look at the Canadian economy. You gotta look at the US exposure as well. If US demand drops, exports shrink, or jobs get hit, the Canadian housing market will feel it. Mortgage defaults could even rise. Now, let's look at what's working and what's at risk. Firstly, Canada has a ton of strengths. Founded in our resources like oil, gas, materials, minerals, we have a ton of that. Huge country, low population. Next, we've got a super strong financial system, and unemployment is relatively low across all provinces. This has paired really, really well with households across Canada holding up despite having high debt. Canadians historically don't miss their payments and will do absolutely anything to make sure that their mortgage is paid. Also, the fact that we're integrated with the US means that we have access to a huge market. This benefits us in really good times. And on that same note, if we're talking about vulnerabilities, because Canada is so reliant on the US exports, if we see trade policy shift or demand soften, we're gonna feel the hit. Again, referencing Q2 of this year with the tariffs. Another weak point in Canada is mortgage exposure. It's really high. Affordability is really tight. And a lot of households have a really small buffer zone for if jobs became less secure or if rates went up a little bit. Like I was saying earlier, in Canada, GDP growth per capita is a bit lagged, and we've seen a bit of a decline in Q3 this year. That's also going to be paired with a low business investment. There's overall really high uncertainty regarding trade between the US and Canada right now. Here are the US strengths and risks. Strengths are that it's a large economy with vastly diversified sectors and a huge market, so it has less dependence on one trade partner. Risks: high debt, both government and households, inflation pressure, global resistance, and the fact that the US policy shifts can have global repercussions, like trade wars and tariffs being thrown around by everybody. And the risk for Canadians regarding the US economy is going to hold up, but us as Canadians can't truly capture the benefit. Because we export so much raw goods instead of unfinished, higher priced materials, we're just not really getting the best value for everything that we make here in Canada. Here's a forward look on what the future looks like between the US and the Canadian economy. Canada's outlook is not that exciting. Like I said, GDP so far has been 1.2% this year, and it's not expected to rise. It's really just expected to soften. Because trade momentum is weak, business investment is low, and overall exports are facing a bit of resistance, Canada's growth for the near future is not looking too good. On the real estate and mortgage side, well, with weak growth and high debt, interest rate sensitivity is still really high. The Bank of Canada has cut rates this year, but they even said that they're not expecting to move them any further in the immediate future. If the job market weakens and the overall household stress rises, well, that'll just result in the housing market cooling a little bit further. So for Canadian homebuyers or homeowners, prepare for a scenario where growth is moderate. Rates may not fall dramatically, and the housing market may go from fast pace to stable to possibly even contracting in a lot of markets. On the bright side, let's talk about more desirable locations like Vancouver Island. We're definitely a lot more insulated here, and at the end of the day, people will always want to live in the most beautiful place in Canada. Here's the US outlook and implications for Canada. If the US economy remains resilient, it helps Canada indirectly through export, investment flows, and overall confidence. But if the US slows down, Canada will feel it, because a drop in exports will of course hamper growth here. Therefore, Canadian economic outlook is closely tied to US performance, as well as Canada's ability to diversify. We need more non-US exports, more value added to our manufacturing, and more innovation. Apparently, the Canadian government is now setting goals to double non-US exports over the next decade. So we're not as tied to the hip with US performance. Here's some things you can do. If you're thinking about buying a home, don't just focus on the rate and the payment. Look at your overall job security, the local market dynamics, and what your buffer is financially. Now, if you're thinking about buying a property for the purposes of investing, look at regions with strong demand, amenity rich, lifestyle rich, as these areas will be able to handle a slower economy much better. And if you're already a homeowner, just consider your flexibility. Can you weather modest appreciation, modest growth, possible job change? And most importantly, stay informed. Like I said, the two economies are like this. So US economy, global trade, energy markets all feed into what happens to Canadians. In conclusion, the Canadian and the US economy are kind of tied at the hip. And if you want to understand what's going on in the Canadian economics, you really need to look at what's going on with the US as well. So like I always say, don't be a statistic, be extraordinary, be educated, and be ahead of the game so nothing surprises you. Make sure you align with the right people and stay informed on what's going on around you so you can make the most educated decision and be empowered with knowledge. And I also want to hear what's happening in your market. Are you seeing a contraction, depreciation? Is the market still hot? Let me know in the comments. As always, if you're thinking about buying a home or have questions, you know you can reach out anytime. But with that being said, don't be a statistic. Have a great day. Thanks for watching.